This is a complete ICT and smart money concepts course that will take you from a complete beginner to taking your first profitable trade in 90 minutes. I'll cover the essential concepts you must master, the proper mindset, and 3 proven strategies from my 7 years of experience that you can start using immediately. Let's start. Chapter 1, Promise and Blueprint. Now, first of all, who am I? I've been trading for 7 years and I've mastered every possible ICT concepts. That is not a good thing because you really want to focus on a few concepts, and that is the whole point of this course. However, I mastered these and I really want to, just look at what to focus on and then give it to you in this course. I've also taught these concepts to others. So if you notice here in my YouTube channel, I've started teaching ICT concepts about 3 years ago. So 2 years, but this is actually 3 years. And I've mastered every possible one. So the roadmap of this course is that the first chapter is going to be about the promise and blueprint. We're going to be talking about the promise of the ICT concepts and the smart money and why is this course actually different. Chapter 2, we're going to go over the lie. So what is ICT, the smart money lie, the algorithm lie, and the reality of all these things. And why am I actually mentioning the bad things and then the solution for all of this. And then we're going to go over the core concepts, the concepts that I actually think matters when it comes to ICT. So market structure, fair value gap, liquidity, and we're going to put all these together. Chapter 4 is the mindset because we actually need to take care of the mindset. So there's going to be a disclaimer talking about probabilities, the curse of more, backtesting, and then setting the realistic success. And then the last chapter, and this is where it's like putting everything together. So we're gonna have these strategies. I'm gonna have 3 different strategies that comes from my 7 years of trading experience. So I do think if you stick until the end and then apply one of these strategies, maybe learn all of them and then apply one of them, you're gonna have success by the end of this course when you get the experience. Now, why is this course different? What's the promise here? We're going to be focusing on quality other than quantity. What does that mean? We're going to focus on the concepts that actually matters instead of flooding, most of the ICT concepts here and give you something that you cannot put together, that you cannot take advantage of. So we're going to focus on the quality and forget about the quantity, because other courses will focus on 100 concepts in one video. And at the end of that video, you will get nothing. You will have concepts. You have, pieces of a puzzle that you cannot put together. 7 years of experience, I'll only give you what works based on my experience, the good and bad of ICT, instead of telling you that you'll be trading like smart money and you will catch the liquidity, all of these things. Not really. I'm going to give you the good and bad of ICT concepts. I'll give you a clear framework and clear concepts, and no fake bank level promises. So you're not going to be a bank. You're not going to start your own hedge fund after this video. Not really. You'll be trading same as any other, trading method. Yes, it works. Not as like a lot of people promises, like you'll be trading like banks or hedge funds or institutions. Not really. Now, key points. I want you to remember that ICT or smart money concepts is just one way to read the charts, and it's not the ultimate truth. So if you already have a method that you're using and you're making money, maybe, take a look at ICT or smart money concepts. You realize that there are a lot of similarities maybe between your way and the smart money concepts. We are retail traders using retail patterns. Even ICT concepts or smart money concepts, these are still retail patterns, and that is perfectly fine. So there is, we're not going to go over the cult of sweeping liquidity of retail traders, because we're still retail traders. That is one thing we should be comfortable with. Also, this course focuses on what works, not what sound impressive. Now, I can give you a lot of concepts that you will think, oh my God, this is impressive. Feels like a secret concept. I do know all of these concepts, by the way, but I'm not going to teach you because you get nothing out of them. I want you to keep this in front of you as we go through the lessons. It will keep you grounded and stop you from chasing the hype, which I don't want you to chase. Never chase the hype. You want to focus on what actually matters, what actually works, and what is realistic. Chapter 2, the lie. Now, their definition is that ICT is an approach that teaches you to think and trade like institutional smart money. That is what a lot of people are going to teach you, which is not true at all. These are still patterns coming from pattern recognition skills, sometimes same as head and shoulder patterns, same as trend line patterns, and same as break and retest. All of these patterns, it's still ICT. So we need to set these realistic expectation that you will not trade like institutional after this. However, you can still continue watching the video to get a realistic way to trade ICT and smart money concepts. Before we continue, I've taken everything I've learned over the past 7 years and put it all into one place, Edge School. Inside you'll find structured courses including the exact strategy I use every day, the Edge model. These are some of the trades that I do share before happening and I did take with my community members. You're welcome to join if you want to make the real change in your trading. Let's continue. So, does it work? Yes, it works, but there is more than that. There are a lot of ICT profitable traders that I know. However, a lot of them are actually unprofitable, a lot of the ICT traders. And why? Because they have unrealistic expectation. And it's unfortunately more of a cult. Again, their promise is that you want to trade like smart money, think like institutional, finally understand how the market really works. No more guessing, you will see the algorithms next move. And this is the ego trap, and that's why I'm mentioning this at the beginning to set realistic expectation. We don't want to think that we're going to be smart money and then when we fail or when we get a losing trade, then we say this doesn't work, because that is not the reality. There is no the algorithm, because we do have multiple algorithms. Which one are we actually following? Which one are we trading based on? So we are still retail, we have limited capital, we don't have insider information, and we're just using fancy terminology for that. However, institutions have billions in capital, direct market access, and then a lot of professional equipment. We cannot call, support and resistance levels or break and retest. We cannot call it an order block. That is not going to work. So we need to forget about this way of thinking from the beginning. Now, what's the reality is that every strategy works sometimes. Either you're going to call yourself trading like, Goldman Sachs or JP Morgan, your strategy is still going to work sometime. It's like a coin flip. Now, why most courses fail when it comes to ICT concepts? Because they do give you a puzzle that you need to solve yourselves, which is not even solvable. Now, these are some of the ICT concepts. You see, we have a lot of them right here, and I do have a lot more of these. These are some of the ICT concepts. When you have a way of trading that has this amount of different concepts, it's not even a trading plan. It's a puzzle. So if we have this price action leg here, from this point to this point, and these are the PD arrays. These are some of the ICT concepts that could push price lower when price is going up. So now think about it this: fair value gap, price could go lower. Breaker block, price could go lower from here. Another fair value gap, price could go lower. So we could either respect this one or disrespect. We could go to this one or to the fair value gap above. But then we could also go to the order block. Now we could go to these Fibonacci levels. But also, one possible scenario is that we're going to disrespect all of these and we're going to go to the liquidity. But still, maybe we're going to respect this one. So we're going to, avoid all of this and respect this. So you see, it's a puzzle. And this is why most courses fail, because they give you this puzzle, they give you all of these concepts which not work together. So if you learn all of these, you'll be confused on which one to actually look for. Now, why I'm starting with the bad things about ICT? To save you from wasted time, to set real expectations, to show you why this course is different, to clear the noise so you focus on what actually works. This is what I want you to focus on, okay? 4 things I want you to always remember when going through this course. What's the solution here? We need to stop trying to solve the market and start playing the probability game. This specific rule here, this specific advice, if you apply this to any trading strategy, it's still gonna work. It's like a coin flip. If there is an edge of, about 45% or, even 30%, if you have that edge and apply this probability advice, and play the probability game, you'll be profitable just by applying this. But if you're trying to solve the market, to solve the algorithm, to trade like robots, this is not going to work. Now, we want to focus on something simple rather than something complex. We want to find something repeatable instead of finding something perfect that only comes once in a year, which is not going to be repeatable. We want to look for something statistical other than predictive, and we want to trade probability and forget about certainty. This is the solution in order to become a profitable trader. Chapter 3, Core Concepts. Now, there are a lot of different ICT concepts, as I showed you earlier. However, there are 3 concepts that most of the setups that you see on YouTube, most of the different ICT strategies, a lot of them seem different. However, they all share these 3 core elements: liquidity, fair value gap, or we can, consider this as a PD array. So I'm just picking fair value gap because it's the best among them. And then market structure. These 3 concepts, you can make and create your strategy of these, and you can look for these 3 when you go to YouTube and look for any trading strategy. You'll see that most of these strategies just share these 3 elements, and you'll realize this at the end when we go to the strategies. Now, first of all, market structure. Now, in my opinion, I would say market structure could be actually the most important concept in trading, because what is it? What is market structure? It's simply the pattern of price movement over time. So if you cannot read that pattern, then you cannot read the market, okay? So think of it like stairs. Uptrend is going up the stairs, which feels like higher steps each time. Downtrend is going down the stairs, that feels like lower steps each time. And then sideways is walking on a flat floor, so there's no clear direction. Now this is the stair. Uptrend is going higher every time. Downtrend is going down the stair, so a step down every time, lower steps. Sideways is just doing nothing, walking on a floor. You'll see you're still staying on the same level. So this is the same level. You're still staying here. You're just walking on the floor, and it has no clear direction. So this is the 3 signatures of market structure. Now the details of market structure. This is, for example, a chart. So we have price action chart. Prices going up sometimes, going down sometimes. The details of market structure is that, and this is what you need to understand. In an uptrend, we see, so if I just ask you a question, and keep it simple and be logical here. Where's a phase of an uptrend in the market? What is uptrend? Is higher highs and higher lows. It's like when it comes to a stair, it's going up, going higher steps. Okay, so what do we see here? We can see that we have a high and then a higher high, and then another high that is also higher and a higher high. So if I ask you, where's an uptrend in this market here? You can clearly see that this is the uptrend where market is going up. Where's a downtrend? It's this one here. And logically, where's the consolidation, or where's the sideway move? It's this one here, because price has been creating highs that are almost equal and lows that are almost equal. So we're staying inside of the same range. This is a ranging market. This is a sideway. This is a downtrend, and this is an uptrend. Now, these are the details here, but logically it's very simple, and these are the details that you want to know about the market structure. So when is the change happening in the market structure? Because if you remember from the previous slide, we had price doing this, going up, but at some point it started going lower, and then the trend changes, right? So when it changes is this. We have 2 types of market structure. We have the break of structure, and we have the shift in the structure, the market structure shift. So we have the break and we have the shift. The break is the continuation type of market structure. The shift is the reversal type of market structure. So 2 things here. Now, break of structure is when we have a high. So we have price going up, breaking above a high. Now we create a new high, which is this one here. Price goes lower and then breaks the high again. That is a breakout structure because we are staying inside of the same trend. We are still breaking highs. Now, if price continues like this, goes lower and then takes the high, that is another breakout structure. It's a continuation. Now take a look at this market structure shift. It's a reversal instead. So you see, price is going lower. We have a breakout structure, a breakout structure, a breakout structure. Now, this is a low. Where's the high that was responsible for taking this low? It's this one. What happened here, at this specific point, when we go above, we created a lower low. But then we take the last high that we created, and then we started a change, creating higher highs. And you see here, instead of creating a lower low, we actually created a higher low. And then we break the high. That is a market structure shift. If we want to keep it simple, it's the break of the last low in the structure or in the last high. So you see this high here, we take the low, we take the high and we break above it. This is a market structure shift. In a bearish scenario, it's price going up, take it, breaking above the high, but then breaking below the low, this low here. That is a market structure shift that is bearish. Now, think about it as a crowd walking upstairs. When they suddenly turn around and start going down, that is a market structure shift. So you see price or people, in this case, going up on the stairs, but then turn around and goes lower. That is a market structure shift. And it is a reversal here. A breakout structure is a continuation. So focus on these because these are going to be some triggers when it comes to some of the strategies that we're going to go over. We need to see a market structure shift, and sometimes we need to see a breakout structure, continuation and reversal. Now, the purpose of this, the breakout structure and the market structure shift, is only one. It is to give you a high probability range or leg to trade from. That's it. All of these details for this specific purpose. Anyone tells you otherwise, it's all going to come back to this specific point. Any strategy focuses on this. What does that mean? We have a breakout structure here, right? So breakout structure gives you a high probability range to trade off, which is from this high until the low where the retracement start. This becomes a high probability range. And why? Because it caused the breakout structure. Same thing here. It caused a breakout structure from this high to this low. That is a high probability range. Now, same thing here. From this range, from this high to this low, that is a range that we can trust. Now, we talked about breakout structures, which are these breaks to the lower side. However, what happened here? Should I take this one? Now, this is the question you always ask. What happened on this range? What this range did in order to consider it a high probability? What are the signature of it? In this case, we can notice that we were in a downtrend, and then we broke this high after taking this low, and we could be now creating a higher low, which is here. Now, from here to here, before anything happening, we see a market structure shift. Now this becomes a high probability range to trade off. Price goes lower and then going up. Now we take this low here and we trade from here. What happened after? If you notice, price going up just like this. Did we trade based on this? Even though it worked, and it's gonna work a lot of times, but it's not a high probability range that we can actually trust. And why? Because if you notice, it did not create any structure signature. So not a market structure shift and not a breakout structure. However, this leg from here to here, it actually created something, which is a breakout structure to the upside. So now from here to here, we can actually look for a creation of a low in order to go higher. So there is a big difference here, and the main purpose again is just to find a high probability range or leg to trade from. Now, my way of reading market structure is very simple. Now, this is a simple way just based on one question, and that is question is, what phase are we in right now? Now, if I ask you here from, price going higher to here, breaking structure, and now pulling back. Now you want to ask yourself, what phase are we in? Are we in a continuation or reversal? Now, continuation means we had a breakout structure. Reversal means we had a market structure shift. That is one thing. Now, the other question and the main question, in my opinion, is, Are we creating a higher high, lower high, higher low, or lower low? That is our question. Now here, when price breaking low and retracing up, what are we creating here? In this case, we are creating a high in order to go lower, and this high is a lower high. That is a simple question. Now here, after breaking structure and then price is going lower, what are we doing here? What are we trying to make? We're trying to make a low. So we are about to go up here, and that is only a retracement. What is this low? That is a lower low, because we had a low here, we had a breaker structure, that is a lower low, and then we're gonna go up in order maybe to create a lower high to go lower. Now in this one here, we are going lower, breaker structure, we went up, we went lower. Now here, before anything happening, what we were trying to make here, a lower low, right? And then we started going up. Now we broke the high. What are we trying to make here? Very simple. Now, in this case, a high going lower, and then we're trying to make a low to go up because we had a market such a shift, and now the trend is bullish. So that is a very simple way to actually know what to look for. So that is an automatic bias for you, either to buy or sell. In this case, I'll be selling most of the time. I'll be buying most of the time. But, definitely when we reach a key level, and definitely with a confirmation entry. So some examples of reading market structure, but the simple and easy way, because when we focus on market structure, if it's not too clear, then we need to ignore it and focus on the clear one, the one that we can actually trust, because it's about focusing on what is the purpose, focusing on high probability ranges and high probability price action legs to trade from. Now, if we look at this price action here, and I'm just going to go like this, and then what you want to focus on is one zone that we failed to displace above, and then we had a breakout structure or market structure shift, and then you want to look for another breakout structure and something like this where we have a clear trend. Now, if we start from a point where I can see the structure being a bit more clear instead of something ranging, we can see at this point we have failing to displace above, and price only wicked above one candle and then started going lower. And what do you notice after that? So we've been moving on the general picture, we've been moving up, but at some point we have a low here, we have another low and another low. Price closed below all of these. Whenever we have this is a market structure shift, indicating and giving you some signals that we might be starting to reverse. We might have some weakness here and starting to reverse. We have this high, which is the highest high in this range, and then we started going lower. This is where the pullback started to the upside. Now, when we have this, because this leg here caused a breakout structure or market structure shift for multiple lows and multiple structures, that means it's a high probability range to look for trades. Now, any key level here, any reason to enter, let's say you enter from here, it does not matter, okay? We're not teaching anything but market structure here. What happened? Price immediately started going lower, and we have this structure, we have this one here, and then we have this one here. And if you notice, this price action leg here caused a lot of breakout structures and strong ones too. So now, from this point where we started the pullback, we have this external market structure. External means the main one. Now, this is an internal one where price just moves inside of the previous range that we have. So consider the internal one is where you want to look for the trade. So you see, you have this high, you have this low, that is a high probability range. When price is going to your entry, for example, so this is a fair value gap, you want to look for entry. That is, the price approaching your entry is the internal one. And if you notice, price gets somewhere, so let's say this imbalance here, and then what happened? So if you notice here, price went lower, respected the structure, kind of respecting, and then started going lower, also respecting, and here we have failing to displace, and then closing below this, and below this, and below this, and below this. So multiple structures here, broken below. What this creates for us is another high probability range from here to here. This is a range where we can actually continue on the same direction, and that is how you understand market structure. This is how you understand. You can start from any point, and then you just want to make sure that that price action leg did something. That price action leg broke structure, did a shift in the structure, and we can trust that one to trade off. That's it. That is how you understand. And if you think about the logic of my simple method, which is asking the question, what are we trying to make here? If you notice, we have a high, a lower high, and then a breakout structure. When price was going up, it does not matter where the zone is or anything. You know, when we think about the market structure logic, we're thinking about what are we trying to create now. So as price was going up, what are we trying to create? A lower high, because we have a high, and we have a breakout structure. This one is lower. Now we're trying to make a lower one. That's it. You want to keep market structure simple. Now, the second core concept on ICT concepts is liquidity. A lot of different definitions on liquidity. A lot of them are not accurate, and a lot of them are just not realistic. Okay, now in my opinion, in simple terms, liquidity refers to an area on the chart where a large number of buy and sell orders are clustered, and most of them in common sense and in the simplest logic. You ask yourself, where do we have a large number of orders, either buy or sell? Always and most of the time at highs and lows. So this is a swing point. A lot of people, if they want to go short, they put their stop losses above. So we have a cluster of orders here. And a lot of people who want to go long as well, they want to see the breakout above. And a lot of people as well, when we have the breakout, they want to look for the retest here as well. So a lot of orders here. We have sell orders, we have stop losses, and we have buy orders, and we have another buy orders when it comes to the retest. So stop losses, it's like get me out if price goes here, take profit, take my profit at this level. So when price comes here, I want to take my profit, and new entries, I'll buy or sell if price reaches here. And that is why we have a large number of either buy and sell orders clustered at the highs and lows. Now, a lot of people are going to tell you that, you know, every high and low, we're going to have a liquidity sweeps, and a lot of orders are there, so we're going to sweep them in the reverse. That is not a logical way and a realistic way to look at liquidity. There are two different outcomes when it comes to liquidity. Two different scenarios that could happen when we take that liquidity. This liquidity here is a fuel, right? So it either reverses from or it helps displaces above. These are the two scenarios. So not every high or low means reversal. A lot of people just look at this way of, you know, reading the chart is when we go to a high, we're going to have a reversal. And when we go to a low, we're going to have a reversal. But think about it this way. We could have a breakout structure, right? A lot of time we have a high and we have a breakout structure. So sometime we're going to have a displacement. Sometime we're going to sweep and reverse, same as here. We're going to go take the high and then immediately reverse after sweeping, after failing to actually go above, displacing above. Another scenario is displacing above here and then continuing in the same direction. Think about it as a liquidity sweep or a breakout structure. That is the difference. So two outcomes are possible and not only one. It's not always a reversal. Think about liquidity as just another key level, very similar to support and resistance levels, supply and demand levels, fair value gaps, order blocks, anything. You know, these are all key levels and liquidity is one of them. It's one of the levels that based on probability we use. We don't know what support and resistance is. We only know that based on probability, these zones work sometimes. Same as supply and demand. It's not, you know, by definition, it's not a supply area or demand area that institution use, but instead it's just an area that based on pattern recognition, based on probabilities, it works sometimes. So it works sometimes and fails sometimes. Even if we go lower, we take liquidity, we go up, we're still going to take liquidity again and liquidity again. A lot of people I see on YouTube teaching liquidity as if price take that liquidity. There's no liquidity above. That's what they say. And price is never going to take that high. But go to the chart yourself and you're going to see that a lot of time we take a high and we take it again and again and again. So it's not that when a high is taken, there is no liquidity. That is not accurate. It's just based on probability. It's a key level that a lot of time reverse from, a lot of time displaces above. So that is how we should treat it. It's not something that will work all the time. It's not the holy grail. It's just another key level. Now, the third concept is a fair value gap. Now, as I said, fair value gap is part and one of the PD arrays. PD arrays are different entries and different key levels inside of a price action leg. We're going to focus on fair value gap for this course. And why? Because we want to focus on something specific other than looking at all of the different scenarios when we have one price action leg, which we call the puzzle. Now, what is a fair value gap? It is a small gap left when price moves too quickly. There is no institutions involved. Sometime based on the the volume at that area, sometime price will go up even without institutions being involved. The way we think about banks, pushing price higher. Not like this. It shows that trading was not balanced there. It means that there was a lot of selling or a lot of buying. And price sometimes come to fill part of the gap. Sometimes the whole gap, sometimes part of it. Now, why it happens again? Sudden news or event. Sometimes, yes, because of news, large orders hitting the market, emotional reactions from traders, and sometimes simply normal market mechanics. A lot of time when we have small retracements, we're going to have a lot of fair value gaps. That does not mean that banks were just buying here and, that way of thinking. Not really. It's just a normal market mechanics. That's it. Now, in a very simple way, a fair value gap is just a 3-candle pattern. So if you notice, it's a pattern at the end. It's a pattern recognized by looking at the chart. That's it. So, and people notice that it works sometimes. So what is a bullish fair value gap? It's when the low of the candle 3, which is this candle 3 here, is above the high of candle 1. So if you notice, this low here is above than this one. It creates a gap. In other words, it's when the high of the first candle does not overlap and touch the low of the third candle. Now, in a bearish scenario, this is a bullish scenario, and it means that sometimes price will go lower to retest the gap in order to go higher. And that is why we use it, because sometimes it actually offers, a fair value. It offers a fair value. I'm not gonna buy from here. I'm gonna wait for price to come here and then buy. It's gonna give me better reward to risk, and it feels like a fair value. Now, same thing here. A bearish fair value gap, on the other hand, is when the high of the candle 3, which is this one, is below the low of candle 1. So you see, this one is below the low of the candle 1. In other words, same as this scenario, when the low of the first candle does not overlap and touch the high of the third candle. That's it. It's a 3-candle pattern, and when we have 3 candles, sometimes we're going to have a gap and sometimes not. Sometimes we're going to have a very big imbalance, and sometimes it can be very small. So it does not necessarily mean that there was no trading happen at that time, rather than, there was a small range where, price moved a bit too quickly. Now, when it comes to a fair value gap, a very important tip is to focus on the 50% level of the fair value gap. That is actually going to filter out many weak setups, and a lot of time you're going to avoid losers, and you're going to keep attention on higher probability trades. So if you just focus, when we have this gap from this high to this low, candle 1 and candle 3, we're going to look at the 50% of this gap. So we're going to mark the gap and then take either a Fibonacci or Gamma box, draw it from the low of the fair value gap to the high of it, and then it's going to show you the 50% level. You want to filter out a lot of the trades, and you want to focus on the 50%. That means if price comes to the beginning of the fair value gap, maybe not take it. look for the 50%, because even if price reach the beginning of the fair value gap, there is also a potential it's going to go lower into the 50%. And 50%, in my opinion, gives the most accurate entries. The thing is, not all fair value gaps are equal. Some are actually meant to be respected, and others are also meant and created to fail. Now, I did explain this on the 6 fair value gap secrets ICT Never Told You video, so make sure to watch this one in order to have a much better understanding of fair value gaps and also focus on high probability. Actually, the purpose of these 6 fair value gap secrets is to move from just trading any fair value gap into focusing more on the high probability ones. So just a quick disclaimer that a fair value gap before a sweep, it's mostly disrespected and inverse. So this is the type of fair value gaps we don't want to trade. Anything before a sweep is mostly disrespected and inversed. Fair value gap after a sweep is high probability and mostly respected. So we always want to look for fair value gaps and focus on fair value gaps happening after price going into a key level and after a liquidity sweep. Now, this is an example here is that we have this liquidity sweep and we come back to the range. We have a fair value gap here. This one is in blue, which is before sweep. This one is in orange, and it happened after this liquidity sweep. This one is gonna work and this one is gonna fail. And same thing here. We have price taking the low and then immediately going higher. We had no displacement here, so price just maybe wicked below and then started going higher. We create a fair value gap after. This fair value gap before is going to be disrespected, and fair value gap after is respected. So we always want to focus on fair value gaps after liquidity sweeps. So putting all together the 3 concepts that we discussed, when it comes to market structure, the purpose is to define direction. So we look at trend or shift, simply continuation or reversal, breakout structure or market structure shift. So these 2 things. So we define the direction using market structure. Then liquidity comes and it acts as targets plus key levels for signal. So it tells you when to actually take a trade. And then fair value gap, we can use it for precise entry and fair value entries after we determine the direction and the signal. Chapter number 4, the mindset. Mindset is first and then a strategy comes second. That's why I'm having this section even before the strategy section. And why? Because without the right mindset, any strategy will fail. That is one rule that applies, on the whole trading industry, is that if your mindset is not there, your strategy is going to fail, definitely. So the first one is a great strategy with a weak mindset equal to failure. A simple strategy with a strong mindset equals success. So what matters here is the mindset more than the strategy. And this chapter is the foundation of your career. So if you understand and apply these next slides, you already have an edge, and that edge is your mindset. One thing we also need to apply is the concept of probability. Every trade should be considered as a coin flip. Why? Because every trade can either fail or win, right? Or succeed. And that is a 50-50 chance. So it's like a coin flip. You never know the next outcome. That is one thing you should understand. Even if your strategy has an 80% win rate, you still don't know the next outcome because it could be part of that 20% fail, as an example. Edge only shows over many trades. So you cannot just take few trades and come to a conclusion that you have an edge, that you have a working strategy. That's not going to work. You need to take many trades in order to consider the the win rate and if your strategy works and if you have an edge. One trade means nothing. So if you win one trade, it means nothing because again, it's a coin flip, 50-50. It could work and it could fail. One trade means literally nothing. Now, another thing I want to mention here is the curse of more, shiny object syndrome. The problem is that a lot of people, when they learn 3 concepts, instead of mastering these concepts, what they do is go and learn more concepts. And that is a big issue. They think that it's all about the quantity. In reality, it's about mastering and taking advantage of these concepts instead of learning more and then just having a noise. So what you need from this moment is to stop collecting and start mastering. So you want to stop collecting new concepts, but start mastering what you already have. A new equal distraction, but old equal mastery. And you want to look for any concept that you learn, you want to apply it on 100 trades first, and then you start mastering. And then if it doesn't work, then at least you put the work. You did backtest 100 trades. If not, you might be just learning a new concept, and then it's gonna equal to distraction, and you cannot apply 100 concepts, but you can actually apply each at a time. That is the way. Backtesting. Confidence does not come from watching videos. So you are watching this video. If you decide to watch this video and then go and take a trade, that's not gonna work. Why? Because you have not gotten the experience you needed. You only watch the video without doing anything. But the experience and the confidence comes from doing the work. So you need to actually do the work instead of just watching the video and then start applying. So you want to see patterns repeat. When you have the enough data and you have all of the the win rate of your strategy and then the average reward to risk, and you know that from 5 times you could actually lose twice, then you can actually be confident. Not confident only about the winning, but also about the losing, because that is confidence as well. You know that you could actually lose twice and then you get a winner. So you now have data which is going to equal to confidence. You know your winners and losers. Another thing is realistic success. Real trading is not a straight line to the moon. So you want to look for small, consistent gains instead of risking your whole account in order to double it in one trade. That's not going to work. It's about consistent small gains, long flat periods, and we want to look for slow growth. That is the real one. That is the real growth. So if if you see someone flipping accounts 24/7, that is not real trading. That is gambling, because they could flip 3 accounts but then maybe lose another 3 accounts and it's gonna do nothing. So it's all about the small consistent gains. Chapter 5, the strategies. So you will have 3 strategies that are built from 7 years of trading experience. They are simple, proven, and repeatable. You want to pick one, master that one, and then test another if needed. That is the way. You need to put the time into each strategy. If you don't put the time, probably it's going to fail because you haven't gotten the enough experience. See it in real market, get the confidence, and then if it doesn't work on a demo account or in a small account, then you can test another one. Even though if you master one, even a coin flip could make you money, right? But then you want to master any strategy you apply to the market. Now, strategy number 1 is the session sweep. So the session sweep is a very simple one. First of all, we need to set up the indicator. This is the one. So you want to go to trading view in the indicator section and look for this specific indicator. Have these timing. So Asia, we have 3 sessions. When we talk about the session sweep, it means I want to see a sweep, liquidity sweep of a session high or low. So we have a session range and we want to see a sweep. You want to have these timing, Asia from 20 to midnight, London 2 to 5, and New York 7 to 10. All of these are in EST time zone. Now, this is Asia here. This is the low of Asia, and this is the high of Asia. Then we have London. This is the high of London and low of London. Actually, this one here, because this is the lowest low in between these timings. And then comes New York. All I want to see now, this is the indicator. It's going to show you like this. So the rules of the session sweep. When we have displacement, and when I say displacement and failure to displace, so when we talk about displacement, I mean above the high of the session and below the low of the session, any of the 3 sessions. Displacement means we have a continuation, means for this specific strategy, it means that we have no trade. Failure to displace, on the other hand, means we have a reversal, and that means we have a possible trade. That is, the main premise is that we want to look for failure to displace. Failure to displace means liquidity sweep. That is the main premise again. Now this one works the best with gold, and I have a video backtesting this specific setup. It's also good with euro dollar, pound dollar, Aussie dollar, and most of the major pairs. Now what are the ranges that we're going to focus on? We have 3 ranges, and these are the sessions highs and lows. So we have, the first one is from 20 to midnight, and all these timings are in EST, in New York time zone. And the indicator that I'm using is this one here, so Asian session range. These are the settings here. Simply you can use any session highlight indicator, okay, but this is the one that I use, and there is full tutorial on this on all of the indicators that I use. We're gonna go with these sessions, so from 20 to midnight, and then from 2 to 5 a.m., and then from 7 to 10 a.m. So these are these session timings. Now based on these timings, we want to see, are we actually displacing above the previous session? So if we're looking at New York, okay, New York on red starts at 7. We want to see, are we actually displacing above London and above Asian? If we're displacing, then no trade. If we're failing to displace, meaning we're having a fake out, then we trade from there. Same thing, if we're looking at London, then we look at the previous one, which is Asia. Now Asia, usually we cannot trade it. So if you're looking at Asia, you want Asia to finish, and then you have possible opportunity at London and at New York. When New York open, you have 2 ranges to look at, London and Asia. And we have different possibilities and different scenarios here. Now the rules goes like this, and these are the ranges. So from 20 to midnight, you can use an indicator to actually highlight the start, the end of the session, the highest high, and the lowest low in between these times. So we're gonna go with these, 20 to midnight, 2 to 5, this is London, this is Asia, and this is New York. So the whole thing here is we want to notice how price behaves when price reaches the high of Asia and the low of the Asia in the London kill zone. What must happen is that if we are taking the Asia high here, it needs to be taken in London, so it needs to be taken after 2. If it was taken before 2, we could actually just include it at this range. So if price actually takes, or makes a high here in between midnight and 2, we can consider it part of this. But if you're a complete beginner and you just want to stick to the basics, then if it's taken before, you just ignore everything. You want 2 a.m. to start in between 20 and midnight range, and something like this starts here, and then after 2 a.m. we take the high of Asia. Whenever this happens, we can trade. Now we go lower, we're going to discuss everything about the entry and about everything, the reward to risk as well. We displace below the Asia low. So if we fail to displace below this, then we exit the trade. But if we follow through and just break out, then we're going to continue. Now a pullback, then 5 a.m. ends here. Now you have the option to hold your trade. I mean, even for days. What happened here is that we start going up. After 5 a.m., we start going lower. And at the start of the New York session, 7 a.m., we take the low of London and we fail to displace below. That means we have a potential opportunity. Why? Because the low was not taken until 7 a.m. We take it here, we fail to displace, and we go higher. Now we can take an entry here. Now what is the entry trigger here is that, let's say this is just the start of the session, or it's somewhere in here. This is Asia. London goes up into that session and then it closes below. There is a video that I also want you to make sure to watch. That video goes over the importance of closure and not closure above or below a high or low. So the closure and the wick plays a major role, especially in this strategy. So I don't want to see a closure above a high or the high of the range. If we fail to close, and then this is a bullish candle, what I want to see in order to trigger the entry is a candle closing on the other direction. So taking a high, or sweeping a high, fake out above a high, in order to trigger an entry, on a high, I want to see a bearish candle. On a low, I want to see a bullish candle closure. That's it. That's it. Now, the candle could be this big, could be this big, okay? Any closure on a bearish candle is considered an entry. So what we're going to be doing is enter here, stop loss slightly above the high, and then target. Now, what I suggest is at 1-to-1, you go break even. And why? Because mostly, if price wants to actually go lower, it's not going to come back to the entry here. Because when we're dealing with liquidity sweeps, what happened is just a fake out and then immediately going lower. So there is not even a potential of price going back to your entry. However, you can take a risky approach and then just target 3-to-1. But to play it safe, if you want to play safe, you can go break even at 1-to-1 and then target 3-to-1 or target, other liquidity levels. But as a minimum, you go 3-to-1. This is the whole entry here. Now, let's go and look at some of examples. So this is gold. This is Asia. This is London. Now make sure to stick until the end because I'll give you some tips and secrets to actually even have a higher win rate and only focus on high probability. Now let's look at some examples, okay? Notice the importance of failing to displace and displacing above or below the high of the range. So this is Asia here, okay? It starts here and it ends here. What is the low of Asia? It's this one here. What is the high? Let me just put it on another color. What is the high? It's this one here. Now, when did we take the high? Is it at 2 a.m. or after 2 a.m. or before? Actually, before. The high was already taken, so there is no entry here. Even if we talk about London, so if London starts here and ends here, did we take the high of London before or after? Actually, after. But the low, it was taken at 6:45. So this is not considered a valid one. We want to see after 7. But here, the low of Asia was actually taken at what time? 9 a.m. So the low of Asia was taken on New York, which is a valid example. Now we failed to close below, and then we print a very small bullish candle. This is your entry here. Stop loss goes below the low, and then you target your 3-to-1. So 3-to-1 is around here. We actually also displace above that one. So it gives you a maximum of 7-to-1. Now, another example, do we have any entry here? Not really. And why? Because the high of Asia, which is this one here, was taken before London starts. So this is not valid. And then the high of London also taken before New York open, and this one is not valid, even though it worked. And I could just say that, you can take this one here. But for complete beginners, I want to give you something that you can actually use in a very simple way. I don't want to give you a lot of different scenarios. So this one we're not taking because New York starts here. Now for the low, we actually displace below. So there is no trade here. Now for this one, we also have the same thing. So we actually take the low. Now sometime I would, so because this is here, this is the high of London, this is the high of Asia, we close above it, but then there is no wick and then we close below it. Sometime I would take this, but for you, no need. Now let's take a look at another example. No trade here, no trade, no trade here. For this day, we actually have a trade. So we have this one here, which is taken at this one. If you put the stop loss slightly above, depending on how much is it, how big the stop loss is. So if this is the high, just add a bit. If you put it here, then that means probably you're going to be stopped out at break even here. So it goes to 1-to-1 and then back to the entry. Break even here. Do we have entry at the low? Not really. So there's no trade here. For this one, we have a trade. So this is the high of Asia. It was taken not at a session timing, but the low was taken at London. So low of Asia taken at London, entry here, stop loss below the low. And then look at this. It's a huge one, a huge trade that you can actually hold for a long time. okay, and it gives you a huge reward to risk. But you know, because we have another trade on the other direction here, I would say maybe we close it at that time, or just the fixed 3-1, and you're gonna be out in a few hours. Now back to this, just to show you the different scenarios. And in order to even have a higher win rate, make sure to use the logic of market structure. When we have something like this, so this is just part of, you know, having a higher win rate. You break a structure. So we already have a break of structure to the downside. This is the high of Asia as an example. If this high is not strong, that means it did not take a liquidity level. So it did not sweep a strong liquidity level. And then London starts like this. Because we have a break of structure here, taking the high of that, the high of Asia and then reversing is going to be a huge one because we already have a break of structure. So this is with the trend. This is what happened here is break of structure, another break of structure. This one is actually weak. I would consider this as a break of structure, high of Asia. Now what happened here is this, taking the high of Asia, not closing above if you notice, and then closing below aggressively. In this case, probably I would enter of this imbalance, or you could take this one here, or you could, you know, because of the size of the candle, you could have two entries, one at the imbalance and one at the closure of the candle. But this one is still huge. So 3-1 easily done, and then much more until this next trade starts here. So you notice this one here, we have closure below. Now sometime if I have just one single candle closing below and the next candle immediately going back to the range, this is also another one you can take. But I want to make sure that for beginners, you can just stick with the basics. So this one is also another potential because we only close one candle below, another candle above immediately. This can be considered also as a potential trade idea, but I do not suggest doing this one. Now here, no trade because the sweep of Asia or the closure goes before London starts, and same thing for London here. So this is the whole premise of the strategy, and actually this one is a perfect example. What happened here is we've been pushing lower and then pushing up, failing to, you know, a lot of weakness here. Liquidity sweep. Now what happened here? This is the low of Asia. London goes, so at the London timing, we have failing to close. Now gonna enter here, now here, now here, actually here. So whenever you have this one, you enter the closure of the candle, stop loss because this is actually a huge candle, just gonna be below the low, and you go 3-1 here. Probably you're gonna be stopped at break even unless you enter at the imbalance here. You're not gonna be stopped at break even. So this is probably, you know, either break even or 3-1, but then it goes up. What is another example? There are times where you're not gonna have a trade opportunity because price just you know, going above a session, above a session, and above a session with no potential reversal. So it's all continuation here, and it's totally okay. Now this one, no trade. We go here, there's no trade here. This one actually another trade. Okay, actually this one not, because the sweep happened just before London starts. There is this one here, but also just before New York starts. This one is a valid one where even London stays inside of Asia range. So sometimes this is going to happen. The Asian range is huge, London stays inside, and then New York does not take London low, but takes Asia high and then goes lower. So for this one, entry is going to be here, stop loss above the high, okay, and then targeting 3-1. That is a 3-1, and then price reverse going higher, another sweep, and then going lower. So finally, I want to give 4 tips and 4 secrets that I learned using this specific strategy that can even give you higher reward to risk and higher win rate, and then avoid some of the setups that don't seem valid. They might give you some profit, but they're not sustainable. They're not trades that you want to take all the time. So the first one is London sweep is the best. It's the highest probability setup that you can actually catch. So trading the sweep of Asia, and then when London starts, sweep, going lower, that is your best setup. So after 2 a.m., so this is London here, sweeping Asia high, this is your best setup. This is the best sweep that you can actually take. Now, why is that? Because a lot of times you're gonna catch the high of the day, and you're gonna catch the expansion of the daily candle. The whole daily candle had been caught here. Now, number 2 is don't trade against it. So what is it? It's the London sweep. Never trade against it. And why? Because when trading against this, what you're probably gonna catch is maybe something like this. But even if you get a sweep here, going to the upside and then looking for the continuation. So catching this here is just catching the pullback to the continuation to the lower side on New York. So this is what you're probably gonna do, is catch this specific pullback to the, rebalancing the range to go lower. So do not trade against it, against the London sweep. Now, number 3 is into a key level. Make sure that the sweep that you're catching, so for example, looking at this one here, so if this was a sweep, are we having the sweep into a key level? And what do we consider a key level? For example, an imbalance or an extreme levels, the ones that we teach in age school. Now, this is a level. This also is a key level. An imbalance is a key level, and I do have the extreme levels that I teach in age school. Any key level, whenever we have that sweep into a key level, it becomes a higher probability. Now, number 4 is trade the direction of the daily candle. Now, what does that mean? The direction of the daily candle is how the daily candle is printing. So a lot of times, and this is very similar to the first one. So if you're trading the London sweep and you're trading in the direction of the London sweep, that means if the high is created on London, then the daily candle, probably the high of the daily candle is here, and we are opening as a reversal. What does that mean? So the daily candle is going to start going up first and then sweep a level of liquidity. So maybe something like this, sweep a level of liquidity, and then it's gonna flip to the downside. And here we can see that the high of London is the high of the day, and now it's a bearish candle. So it's gonna be something like this, a bearish candle, and now it's going lower, 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 lower. So do not trade against this daily candle here. Simply, if you follow number 4, then you're basically following number 1, but in another way. So these are the 4 things. If you actually follow, you're going to have, and you're going to end up with a higher win rate. Strategy number 2, the 2022 mentorship model. So the main premise of the 2022 mentorship model is that we have 3 main steps, and each of these steps kind of similar to the 3 core concepts that we cover. The first one would be a key level. That means any trade I take, I want to see it reacted off a key level. So we have a key level. When only price comes here, I want to take a trade. Now that key level could be fair value gap, could be a liquidity sweep, so it could be something like this. And then I look for the trade. But why? Because we have a liquidity sweep. So first step is the key level. Second one is a shift in the structure. That means displacement. So I want to see, an alignment between different time frames. And I want to see a shift in structure. It means that I want to see this price action leg. We have a higher probability of price action leg. It means it breaks structure, and then an entry. And that is going to be on a lower time frame key level. So it's from a higher time frame key level to a lower time frame key level as well. So when talking about the key level in specific, we want to trade the key level aligned with the higher time frame structure. So that means when price is doing this, this is a key level as a fair value gap, for example. I want to trade off that, the one that is aligned already with the higher time frame structure. So it's already breaking a structure on the higher time frame. For example, if we look at the 4 hour, it's doing something like this, and a fair value gap here. Yes, I want to trade this to the lower side. Now, a key level could be, again, liquidity, fair value gap, order block, etc. Any of the different period arrays and the different key levels, you want to focus on 2 or 3. I would say 2, sometime 1. If you feel like you can wait and you have the patience, then you can look for only 1. Sometime you could do 2, 3. Depends on your, what is something good for you. Some people can actually focus on one thing. Other people cannot do that because they will be forcing trades. So you know yourself more than anyone. Now the time frame alignment, it means that we want to see the alignment between the higher time frame to the lower time frame. The first key level we talked about. So on the previous slide, we're going to be using the higher time frame. So you want to pick one of these, for example, daily time frame or 4-hour time frame or 15-minute. So as an example, let's say I'm going to pick the 4-hour and I'm going to look for a fair value gap with the structure. On the lower time frame, looking for the structure and looking for the entry, it's going to be on the 15-minute. That is where we're going to look for the alignment. Now for the alignment, which is the shift in structure, it's about when the lower time frame aligns with the higher time frame bias. So you remember when I told you that we want to look for this fair value gap here because it is with the higher time frame structure. Now that higher time frame fair value gap, I want to look for price to go there, and on the lower time frame I want to see alignment. That means a higher time frame bearish fair value gap needs to have on the lower time frame a bearish signature. So it could be, again, market structure shift. So this bearish one, I want to see shift. Okay, market structure shift engulfing. It could be even just creating an engulfing candle, right? A candle that is bigger than the previous one, eats the whole previous candle, or a creation of a fair value gap as well. So we could do that. Price could just go to that higher time frame fair value gap and create a lower time frame fair value gap as well. That is an alignment. So on the other hand, if we have a bullish fair value gap and then price going lower, you see we are bearish on the lower time frame and maybe still bullish on the higher time frame. So we are bullish and now we're starting to go lower. This is just part of a retracement on the higher time frame. Price goes lower, break a structure, break a structure, break a structure. So if you notice, we've been moving lower here, but at some point we have a market structure shift here and maybe an imbalance here as well, a fair value gap. When we have this, that means this is exactly where the alignment happens on this price action leg. And why? Why is the alignment right there? What is the signature here? It is that this is a higher time frame bullish fair value gap, and a bullish fair value gap means the bias is bullish here, it needs to be bullish. When does it turn bullish? When we have a break above this high, it's becoming bullish here, and this is where we can actually trade, because now we have the alignment. Bullish fair value gap creating a bullish market structure shift. Now some other examples and different combinations of the 2022 mentorship model. As I said, we could be dealing with any key level, we could be dealing with any alignment type, and we could be dealing with any entry. Now we could look for a key level of a liquidity sweep. So this is a level, on the higher time frame, something like this, and then on the lower time frame we go lower, we take that level and we immediately go up. What is the alignment here? It could be a market structure shift. So we take a level on the higher time frame, and then we have a market structure shift on the lower time frame, and then in order to enter we have a fair value gap here. That is one type of a 2022 mentorship model. Why? Because we do have a key level, we do have an alignment, and we have the entry. Now on the other hand, it could be as simple as this: a fair value gap into a fair value gap. And why? A fair value gap, this is the first one, the higher time frame, and this one is the key level. So I'm using key level here. The second fair value gap is the two thing. It's the alignment, because now we have this higher time frame fair value gap. When price goes, or goes out of it, it creates a fair value gap. So that is an alignment, because now we have a higher time frame bullish fair value gap and a lower time frame bullish fair value gap. So that is an alignment. And third thing is the entry, and this fair value gap can be also entry. So we have 1, and we have here 2 and 3. So if you see, it's all about fair value gaps. So you can actually look for fair value gaps just like this and use it for the key level, alignment, and entry, all of these. That's how powerful an imbalance can be actually. Now, when it comes to the 2022 mentorship model, what do we want to look for? Simply, we want to see a price action leg that is aligned with the structure, and then looking for a key level, and then aligning that higher time frame key level with a lower time frame confirmation. That's simply what it is. Now, we have three steps. First one is the higher time frame key level, and then the alignment and the market structure shift coming out of this higher time frame, and then taking the confirmation entry. This could be also, we discuss the fair value gap to fair value gap entry, and I'll show you an example here. One example, which is, if you notice, now one type is this liquidity level here. If you notice, we did sweep and we failed to close above here on the 4-hour time frame. So we close above. Now if we switch to the 15-minute time frame, and then price, what happened here is liquidity sweep, and then price breaking below this level and this level. What you can do now is take your Fibonacci from the high to the low, and do we have any imbalance here? Not really. So the thing is, on the 15-minute, now when you play with a 4-hour, you can do 15-minute or 5-minute, because sometimes you want to see more details, and these are going to be more seen on the 5-minute. But even on the 5-minute, I cannot see something clear. So there is no imbalance here to enter from. So now you can sometimes simply take an entry from 618, 705, 79. In this case, because we don't have an imbalance, I'm going to pass this, and I want to see what happened here. So if you notice, price goes lower. Now on the 4-hour time frame, you see liquidity sweep, price is going lower. And then now here is the higher time frame level that we want to trade off, which is this imbalance on the 4-hour time frame. If you notice here, we have liquidity sweep and we have a breakout structure. This makes this imbalance a high probability one, so we can actually look for a trade of this fair value gap. This becomes a high probability one. So I'm going to mark this one, drag it to the right. And this is going to be, based on the 2022 mentorship model, this is going to be the higher time frame key level we want to trade off, and then we're going to look for a lower time frame confirmation around the 50%. As we said, always, if you're especially a beginner, focus on the 50% of the imbalance. Now we go to 15-minute time frame or 5-minute. Price is, staying still, not into the imbalance. We want to focus mostly on the 50% here. And the confirmation that you can look for at the 50% is, it depends on your setup. For this scenario, we could look just for an imbalance created out. A lot of the times I want to see fair value gap going in, fair value gap going out, and I'll take the one coming out with the direction. So in this case, let's see what happened. So playing the price action, this might be taking some time. So I'm going to go to hourly, just to make it faster here. So price goes up, okay, and reacted out there. Now, you see, price is getting very close. I'm going to switch to 15-minute time frame here. And it's given a reaction going lower. So as of now, I'm not seeing an imbalance. I'm going to switch to the 5-minute time frame here in case. Okay, so just before that, if you're on the 5-minute time frame, you can see we respected the imbalance. So we have now a higher time frame fair value gap being respected. Now we want to look for something on the lower time frame, and this could be just a fair value gap with a direction. So in this case, you can take this imbalance, you can take it from the beginning, or you can take the 50%, stop loss goes above, and now you want to also have the alignment. So now you could also switch to the lower time frame and have a clear target. Now let me take this to the right, and you can target this low here, or you can target another imbalance, for example, this one here. Now, usually I want to focus on the 4-hour because this is an imbalance of the 4-hour, and I'm, trading based on the 4-hour structure. I want to target as well a 4-hour structure. So I can also notice this imbalance here being partially filled and not to the 50%. So I can target the 50% in this case. And that is a trade. Now, do we get filled here? Let's see. So exactly to the 50%, price started going lower. So that was a very nice, almost no drawdown entry. I want to switch to 15-minute to make it faster here. Price drops. Now for the breakout structure, there is, because the move here started very quick, the breakout structure at this point would not be the best, right? Because we have a big move here. We want to take a trade as soon as possible instead of waiting for the whole structure here where a lot of people would be already out. So the structure on the 5-minute here is huge. You want to at least switch to 5-minute structure, which is in this case almost the same. So trading based on the imbalance here would be a wiser option. Now back to the hourly. See, prices still going lower and then immediately pushing down with a gap. And yeah, that is one trade that we could have traded based on. Now you see, also here we have that liquidity. We could have traded here, but there was no enough structure and we could not get a confirmation there. Now another example is on the daily time frame. We can notice that we've been moving down here, going up. So part of this down move, we started going up, retracement, price going lower. And then here, what happened is a breakout structure. Now if we take our fib from the high to the low, we can see this is the 618, the Fibonacci 618, 705, and 79. This is your optimal trading entry zone. Now what happened is, you could be taking a trade based on the structure on the low time frame, but I always like to trade on a fresh structure. That means I want it to be, so yes, you could trade based on this, yeah, but now we create another structure that is new, and then price immediately maybe coming back to the range here, the new range we're creating. So now you have more of a clear reference point to trade based on. So you could be trading based on any, even here, you could trade based on the structure and look for an entry here. Now I'm looking at this here, and what happened is failing to displace above and then going lower, breaking structure. So based on this, and then we create an imbalance as well. So based on this, I can kind of say that we have a high probability range. And this is the point of the market structure, is identifying a high probability range to trade based on. And we do have this imbalance as well. So we have this imbalance marking this one to trade off. We are in the daily. We're going to be looking for hourly structure or hourly fair value gap, or sometime 15-minute if you want it. Now, okay, so before that, see, we're going to go to the hourly here because I did play this. Now on the hourly, price goes up, did not respect the 50% exactly, went a bit above and then created an imbalance here. What we can do is, because here we're not going to be finding a market structure shift because we don't have swing points. You could go to 15-minute and consider this as a breakout structure and then take an entry based on Fibonacci, because we don't have an imbalance, but we have an hourly imbalance here. So if we take an entry based on the hourly, it's going to be here, stop loss above, and then you're going to be targeting daily levels. For now, I'm going to target this low here, maybe slightly above here, and that is our entry. So price goes close to our entry, all right, and then started going lower and going to TP. This example is just to tell you that sometime you'll do everything right. You'll be identifying the direction, the high probability range to trade off. You'll be identifying the confirmation, and you'll have your limit order. But after that, it's not going to get you in, and it's going to go straight to your take profit. So this is just an example that sometime you will do everything right, but you will not get the entry. Strategy 3 is fair value gap plus liquidity model. Actually, this one is one of my favorites. And why? Because we have multiple confluences here. So instead of focusing only on liquidity levels, or focusing only on fair value gaps, or focusing on any single specific key level, no, we are focusing on two at the same time. So what we want to see is a price action leg within the trend and structure. So I want to make sure that we are with the structure. Price is going lower. We want to look for this with the current structure. Even if it's an internal, we can trade that, or focus on the external as well. What we want to see is this structure having liquidity and fair value gap at the same time. So at the same time, put two lines here. We want to see both at the same time. But how? Now take a look at this. This is the explanation of the model here. What we want to see is a reaction of a price action leg, preferably a market structure shift, coming out of a higher time frame key level. So this could be a fair value gap, or this could be a liquidity sweep. This could be anything. So you are free to use any key level, even what we use with the edge model in the edge school or my own strategy. So any key level here, wicks, for example, this is what we use. Now we take a high and then we take the low, and we broke below a low with a displacement strongly, and we leave an imbalance here. Now what do you want to look for? Fair value gap and liquidity at the same time, right? When does this happen? It happens when we go back to the imbalance, so slowly coming back to the imbalance, and here we come to the beginning of the imbalance and then we give a reaction. When this happens, this becomes a liquidity level, price goes up. So this is the first touch of the fair value gap. Price comes here, first touch, we're going to consider that as a liquidity. So first touch of an imbalance is a liquidity, especially if it just, reacted at the beginning of the fair value gap. So now, before this happening, so let's say we're not seeing anything here. What we have is a liquidity level, which is a liquidity inside of a fair value gap. We mark that one, and we want to see a liquidation of that. So we want to see a fake out above, and then price coming back to the range. You have two options here. One, to enter here when price goes above and then immediately goes lower. You can take an entry here, and we're going to explain that. That is the first entry. Price goes lower, break the structure. So the whole thing here was a fake out. We have fake out, and we have another internal breakout structure or market structure shift, whatever you call it. Now price goes lower, and you can enter here again when you have a new imbalance. You can enter based on this one, because now the business is almost done here. We've been taking a high inside of a fair value gap. That is our model. And then we create another fair value gap with a breakout structure. You can also take that one. So you have two types of entries, and that is the whole model. So simply fair value gap creation, first touch with the trend, we enter on the second touch with two different entries here. So the steps or the checklist, first of all, we identify a price action leg in line with a trend or bias. So as an example, liquidity sweep, a reaction of a liquidity sweep, fair value gap reaction, and we want to see a market structure shift as well in that price action leg. And then the second step is marking the fair value gap formed within that leg, and then we wait for price to retest. So in other words, getting the first touch in that fair value gap and given a reaction. A reaction I would consider just creating a swing point. So simply a reaction would be price going higher and then creating a bullish candle and a bearish candle, and I prefer to see a few bearish candle after that, and then that is considered a reaction for me. And then we enter after the sweep of the first touch. That's it. That is one of the best models that you can see on the whole ICT way of trading. So the whole ICT, based on my experience, this could be the best model. And in my opinion, if you ask me, or if you ask, about my advice in order what to look for when trading ICT or smart money concepts, it would be this model. Now, the fair value gap and liquidity model, in my opinion, one of the best, as I said, and it's, in my opinion, even better to trade than the 2022 mentorship model. Why? Because we do have a refined area and we do have a refined setup that we can trade based on. Now, if you notice, anytime we do have an imbalance, so we do have, I'm going to show you how to, first of all, identify these imbalances. Imbalance here with a breakout structure. First touch is here. Why first touch? Because we went here and created a swing point, so this becomes the first touch. And if you notice, when we take that first touch, we traded lower. Now, where is the second touch? Because that is also another one that we can trade based on. This is the second touch. We could have taken a trade based on this all the way here, maybe sometime lower, maybe sometime the second touch is going to be the final one, and a lot of other times is going to be not the last one, but the third one is going to be the last one. So this is the third touch, and we can also trade as long as the imbalance is not fully filled. So if you notice, not fully filled, third touch going lower. Now, what is another example? If you notice, as well as here, imbalance, first touch is here, and then second touch almost filling the whole fair value gap here. So we could have traded here to the upside. Another example is this one here. So this is an imbalance as well. The first touch is here, second touch is here going higher. And you will be seeing this almost everywhere. And it gives you a very refined range to trade off. And why even this one here, if you notice, this is the first touch of this imbalance, first touch, second touch, and then flying up. So if we go to these and look for lower time frame confirmation, you're going to notice that. So we go to 15-minute time frame here. And if you notice, this is the first touch. We don't trade based on this. You could, okay, but understand that it's not going to be the ultimate one. After that, if you notice, price takes the first touch, goes up, and then reach this level, started going lower. We have a breakout structure here below this point. So this is, it's not the ultimate breakout structure because sometimes it's going to be a liquidity sweep. But in this case, it looks valid to me. So we took the high, break below it. Now you want to look for breakout structure. Now you want to trade based on imbalances. This is an imbalance here. Usually I'm not going to be looking for this one because I want to find one that is above. So a lot of other times I'll be switching to 5-minute time frame and look for an imbalance slightly above that. Now on the 5-minute, we can see a much clearer structure breaking below this, and we do have an imbalance here. And this one, this imbalance here has something. So now we do have a structure that caused a breakout structure. On the higher time frame, what did we enter based on? We entered based on the higher time frame plus the liquidity at the same time, right? Now on the lower time frame, so higher time frame is fair value gap and liquidity. Now on the lower time frame, we can also see something. We can see a market structure shift as well as a fair value gap and liquidity. And where is that? It's right here. If you notice, the extreme fair value gap has something very nice, which is fair value gap and first touch of imbalance. You want to put your limit order if you want to have the best possible entry. Not necessarily it's going to reach that every time, but this is your level. You're going to set it at the high, the first touch simply, and then stop loss above or just above the swing point. Yeah, I'll say around here. And then you want to target the range of the 4-hour or the hourly. Now you see, that is a huge one. So price gave you a maximum of 12 reward to risk. And then let's see what happened after on the third touch. If you notice here, price reached that level, started going lower. Now I want to see first on the 15-minute, what happened on the 15-minute. On the 15-minute, taking the high here, started going lower. So there was nothing on here. On the 15-minute, price goes up, start going lower. So here there's no imbalance. We're going to also discuss the 5-minute on here. Now here we do have multiple imbalances, 1, 2, 3. Now I'll take these 2 consecutive imbalances, actually 3. So all of these 3 and takes them as one imbalance. This is one tip that you can actually follow. Now what happened here is first touch of the imbalance. You can also watch for the 50%, but first touch of the imbalance and then second touch and closing lower. You can actually trade based on this as well. You see, this is the same model that we talked about, which is the fair value gap and liquidity sweep. Now this one is also another one, another possible trade, and price goes all the way down there, and that is another huge trade. Now on the 5-minute, I want to see what happened on the 5-minute. Could we take a trade based on this? I'm not going to consider this a high probability market structure shift because we barely displaced below, just one candle, and then we immediately started going up, and there is no clear imbalance based on this. We started going up, we create an imbalance here. It was partially filled, but the 15-minute structure and the 15-minute imbalances were much more clear. So I would stick to the 15-minute in that case. Now, what do we have? We have same thing here and same thing here as well as here. If we take a look at this here, I'm going to go back in time. This is how it looks on the 15-minute time frame. So if you notice, we have the first touch taken here, price started going up. Now in this case, Let's see the 5 minute. I don't like when we have wicks like this, too big. You have to go with a big stop loss in this case. Now, probably I don't prefer this, but I want to see what happened after that. What is the type of structure we get? Now, in this case, I don't see this as a good structure to trade off, so I might pass this trade. And this is simply the fair value gap and the liquidity method. It happens everywhere that you can actually catch a lot of trades, and you have even a much more clear structure to trade based on. And I can find examples everywhere with a structure. So if you notice here, price going up, this is an imbalance with the trend because we've been moving up. No clear breakout structure here though, but we create this imbalance and then we push higher. So now we create a very, this is the least that I consider as a swing point, which is closing higher, and then we take the low. So that is one possible trade. Another possible trade is this sweep here as well. So if we go back here and trade based on these two trades, so if we go to 15-minute time frame, the first one is here, and if you notice, we take the low, we break structure. Now, not necessarily the best break of structure, but after that we follow through, and then we have what? We have a low with an imbalance. So now we can actually have a higher time frame and lower time frame. There's also one here as well. If you consider this as a valid break of structure, you can simply trade based on this. That is your first trade. Another trade is this low here. That is another one. Another trade with a stop loss below the low. And both of these are valid depending on, sometimes it gets subjective, which is which one are you considered as a high probability market structure shift or break of structure. So these are valid, and you see it went all the way up here. Another one, which is this sweep, you want to see what happened after. Now, probably we're not going to look for break of structure because the swing point is very far. 5 minute, also same thing, no imbalance. There is an imbalance here, not an imbalance. So there is no clear structure here. Probably we're not going to be able to enter based on this. Even an imbalance we did not see being created here. 5 minutes, not really. So there is no valid entry here. You could have taken other entries such as engulfing candle or anything else, but we don't have the fair value gap and liquidity method here. So now by the end of this course, you have everything you need from ICT. You have the main three concepts that actually matters in ICT, and you have 3 different models and strategies that you can start applying. Remember that more knowledge does not equal to better results. So what I could do instead is give you 50 concepts and then 10 different models, but you will do nothing out of these 50 concepts and 10 models. These 3 models, you want to apply them one at a time, commit to one strategy at the end after you backtest all of them. So you apply one, you backtest, you build your pattern recognition skills, and then you gather some data. After that, you commit to the one that you decide you want to go with for the rest of your trading career. That is the end of the course. Make sure to check out It's Cool if you want to learn about my personal strategy that I developed after 7 years of trading, and it's never taught anywhere because this is what I came up with. These are some of the courses we have. These are some of the workshops, and these are some of the trades we take together with the members. Make sure to like, leave a comment, and share the video with your friends, and I'll see you next one.